Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines. Okay, ready to dive into some market movers.
Always.
We've got Warren Buffett making headlines again.
Of course.
The U.S. election is keeping everyone on edge. And then there's some rumblings in the global economy we need to unpack.
Sounds like a busy morning.
Oh, and we even have some drama brewing in the world of convenience stores. You heard that right. Stick around.
Let's jump in.
So let's start with the Oracle of Omaha himself. CNBC is reporting that Warren Buffett has been steadily trimming his Apple stake for the past 4 quarters.
Oh, wow.
And we're not talking about a minor adjustment here.
Right.
Berkshire Hathaway's biggest holding is down a whopping 67.2% from this time last year.
Really?
What's the story?
Well, Buffett has pointed to a couple of reasons for the sell-off. First, he's expressed concerns about potential increases in capital gains taxes, especially with the U.S. government facing a growing fiscal deficit. And second, he wants to diversify Berkshire's portfolio. You know, their Apple stake had become quite concentrated.
Right.
But the sheer volume of the selling, particularly that large chunk he unloaded in the second quarter, has some analysts wondering if there's more to the story.
Interesting. So what are they saying?
Well, Buffett is known for his love of Apple's loyal customer base and what they call the stickiness of the iPhone.
Meaning?
How well Apple keeps its customers within its ecosystem of products and services. It's unusual to see him back away from a company he's been so bullish on for so long.
And adding to the intrigue, CNBC also highlighted that Berkshire's cash reserves swelled to a record $325.2 billion in the third quarter. They're also holding back on buybacks this quarter. Is he seeing storm clouds on the horizon? Or is he just being strategic, waiting for the right opportunity to pounce?
That's the million-dollar question. His moves are often seen as bellwethers for the broader market, so a lot of investors are watching his next steps very carefully.
Speaking of things that have investors glued to their screens, this U.S. election is coming down to the wire.
Oh, tell me about it.
And the markets are definitely feeling the heat. From what I've been reading, it seems like former President Trump's platform centers on tariffs and a more relaxed approach to fiscal policy, while Vice President Harris seems likely to follow a path more aligned with the current administration. But what does any of this actually mean for the markets, and more importantly, for you?
Well, Bloomberg laid out some potential scenarios. If Trump wins, his policies could lead to larger deficits
Right.
and potentially higher inflation, which could push interest rates up. That would likely boost the dollar, but put pressure on bonds.
I see.
The impact of a Harris win is less clear-cut, especially with the possibility of a divided Congress. But regardless of who takes the Oval Office, the uncertainty surrounding the election is making investors hesitant to make any big moves.
It's understandable. And adding another layer of uncertainty to the mix, there's a poll from the Des Moines Register that's causing a stir. It shows Harris leading in Iowa, a state Trump won handily in the last 2 elections.
No way.
Yeah. Bloomberg picked up on this as well, although they caution that it could be an outlier. Could we be seeing an upset brewing?
It's certainly within the realm of possibility. Iowa has historically been a pretty reliable indicator of broader voting trends, so this result could signal a shift in voter sentiment across the country.
Yeah,
But as with any poll, we need to wait and see how things actually shake out on Election Day.
for sure. Okay, let's shift our focus across the Pacific to China. The Wall Street Journal has a piece on China's economy, and it's a bit of a puzzle.
Oh,
Their economy isn't firing on all cylinders,
Yeah.
and everyone's been anticipating a major stimulus package.
right.
Some folks thought they were holding back to see who wins the U.S. election, especially with Trump talking tariffs. But the Journal's saying that's not the real story.
Interesting. So what's going on behind the scenes?
The Journal sources say that China actually has its stimulus plan ready to go.
They do.
Yeah, they're just waiting for the official green light at their legislative meeting this week.
Okay.
The interesting wrinkle is that they are factoring in the U.S. election and how it might impact market sentiment.
Makes sense.
A Trump win, with the potential for renewed tariffs, could lead China to double down on domestic spending, which of course could create even more tension with the West.
Yeah, I can see that.
So they're keeping a close eye on the U.S. election. It's like a high-stakes game of chess, with each side trying to anticipate the other's next move. The Journal also pointed out that there's been some grumbling about China being vague about the details of its stimulus plan. Could that lack of transparency be adding to market jitters? And what would a clear, decisive plan from China look like? And how might it ripple through the global economy?
Well, transparency is crucial in situations like this. A clearly defined plan with specific targets and timelines would go a long way toward calming the markets. The impact on the global economy would depend on the scale and scope of the stimulus. If they go big, it could trigger a surge in demand for commodities and other goods and services.
Makes sense. It seems like the whole world is waiting with bated breath to see what China does next.
Okay.
Now let's zoom out and look at the bigger global picture. The Wall Street Journal highlighted a strange juxtaposition in the U.S. economy: a slowing job market coupled with surprisingly strong consumer spending.
Okay.
Meanwhile, Yahoo Finance UK is reporting growing concerns about a manufacturing slowdown in Europe, and Bloomberg is covering potential supply chain headaches in Canada stemming from port issues.
Are all those pieces connected?
They definitely paint a picture of an interconnected global economy. The robust consumer spending in the U.S. could actually be a positive sign, providing a buffer for the job market.
Interesting.
But those disruptions at Canadian ports have the potential to spread,
Yeah.
impacting global trade and potentially leading to higher prices.
Right.
And you're right, Europe's manufacturing sector is facing headwinds. Their Purchasing Managers' Index, or PMI, a key indicator of economic health, has been below 50, which signifies contraction, for an alarming 19 months in a row.
Wow, 19 months.
19 months. That's a long time to be in the red. So, what's the outlook? Are we headed for a global slowdown?
It's tough to say for certain. There are definitely challenges out there, but there are also some bright spots. We'll need to keep a close eye on several key indicators, including the Bank of England's interest rate decision later this week. That will give us a sense of how they view the global economic landscape.
Good point. And speaking of interest rates, CNBC reported on some rather pointed remarks from Morgan Stanley CEO Ted Pick. Speaking at a panel of finance CEOs in Riyadh, he declared that the era of zero interest rates and low inflation is over.
Oh, wow.
Does this signal a more permanent shift?
Pick's comments definitely echo a growing sentiment in the financial world. The days of easy money are fading, and we're likely entering a period of higher interest rates and potentially more volatile markets.
Not exactly what I wanted to hear to start the week.
I know, right?
But hey, as they say, knowledge is power. Now, before we move on, I have to bring up this convenience store story. The Wall Street Journal reported that the company that owns Circle K is making a play to acquire 7-Eleven.
Really?
Yeah, it's a battle of the convenience store giants, and the stakes are high.
That's interesting.
Why should we care?
This goes beyond just Slurpees and hot dogs.
Right?
This potential merger is a sign of consolidation in the convenience store industry.
Hmm.
More than half of U.S. convenience stores are still owned by single operators, so this deal could be a harbinger of a major shift in the industry landscape.
The Journal also pointed out that antitrust regulators might have something to say about this deal, especially considering the high concentration of stores in certain areas.
Yeah.
Could this be a David versus Goliath situation, or will the convenience store giants prevail?
It's hard to predict how this will play out. The Federal Trade Commission, or FTC, is already keeping a close eye on consolidation in this industry. They forced 7-Eleven to divest 293 stores when they acquired Speedway back in 2021. But Couch-Tard, the company behind Circle K, has a long history of successful acquisitions. They've even stated that mergers and acquisitions are a key part of their growth strategy.
Interesting. I never thought I'd be so captivated by the fate of convenience stores.
It's a good reminder that even industries that might seem mundane can be impacted by major market forces. It's always fascinating to see how these battles unfold.
You're telling me. Okay, I think that's a good stopping point for part 1 of our deep dive. We've covered a lot of ground already, from Warren Buffett's Apple sell-off to the nail-biting U.S. election, China's economic puzzle, global market trends, and even a convenience store showdown.
It's certainly been a whirlwind tour of the financial landscape.
It has. Hopefully our listeners are feeling a bit more informed about these key market developments.
I hope so too.
We'll pick up the rest of this deep dive in part 2, where we'll explore some intriguing stories that didn't make it into part 1. Stay tuned.
You know, while we're on the topic of global trends, I think it's worth mentioning that there's a lot of focus on the U.S. consumer right now.
Oh, totally. MarketWatch even had a whole piece on how anxious consumers are ahead of the election.
Exactly, and several companies are highlighting the impact of this uncertainty on their earnings calls. eBay, for instance, mentioned that greater consumer attention on the U.S. elections is contributing to a challenging operating environment.
And it's not just the election jitters, right?
Right. Wells Fargo CFO suggested that consumers and businesses would feel a bit better once the election is over, especially if interest rates come down a little.
Yeah.
It seems like everyone's holding their breath.
It's like waiting for the other shoe to drop. But then you've got companies like D.R. Horton, the home builder, saying that potential homebuyers are waiting for lower interest rates in 2025.
Mm.
So maybe it's not just the election, but also the expectation of an economic shift.
It's probably a combination of factors. And let's not forget the impact of inflation, which has been squeezing consumers for a while now. Even with the Fed's recent rate cuts, we're not out of the woods yet.
It's definitely a complex picture. Okay, so we've got anxious consumers, economic uncertainty, and a whole lot of election drama. What else is brewing in the world of markets?
Well, you mentioned earlier that Berkshire Hathaway reported its third quarter earnings over the weekend. CNBC noted that their operating earnings were a little light, but that's not necessarily a surprise given the current economic climate.
Right, and with that massive cash hoard, they're in a pretty strong position to weather any storms.
Exactly. They can afford to be patient and wait for the right opportunities to deploy that capital.
Okay, before we move on to our final part of this deep dive, I have to ask, did you see this coming? Apparently, former President Trump's campaign posted on social media claiming to have JP Morgan CEO Jamie Dimon's endorsement. But then, according to Bloomberg, the bank had to swiftly deny it.
Wow. That's awkward.
It is, especially since Dimon himself has pledged to work with whoever wins the election.
Mm.
He's trying to stay neutral. But his wife, Judy Dimon, is actually out there campaigning for Vice President Harris, knocking on doors in Michigan. Yeah. Bloomberg even got a statement from her about the high stakes of this election.
Well, there you have it. Even in the seemingly buttoned-up world of finance, the election drama finds a way to creep in.
For sure. And it's a reminder that behind those big institutions are real people with their own opinions and beliefs.
Absolutely.
Okay, I think we've covered a lot of ground in this part. Ready to move on to the final leg of our deep dive.
Absolutely. I'm sure there are still plenty of surprises waiting for us in the headlines.
Okay, so for this final part of our deep dive, let's zoom back out and look at the bigger picture. We've talked about a slowing job market, but what about that surprisingly strong consumer spending? Yahoo Finance UK said the U.S. only added 12,000 jobs last month.
Yeah, way below what economists were expecting.
But spending is still strong. What gives?
That's what's got everyone scratching their heads. The Wall Street Journal even called it an economic puzzle. Because on one hand, you have this hiring slowdown.
The lowest since the pandemic hit, right?
2020, exactly. But then on the other hand, consumers just keep spending.
So is that good or bad?
Well, it could be both. The optimistic take is that strong spending supports businesses, maybe makes them less likely to lay off workers.
So keeps the economy going.
Right. But some people worry that the spending is coming from savings or credit cards even.
Which wouldn't last forever.
Not really, no. The Journal even quoted the Atlanta Fed president calling some of these economic reports janky,
Janky.
meaning they're all over the place, hard to interpret.
I like that word. But seriously, how does the Fed even make decisions when the data is so confusing?
Well, as the Wall Street Journal explained, they try to focus on the overall trend, not every little up and down. Their goal is still to get inflation down further, and they're watching how fast wages are rising as a clue to what might happen with prices later on.
Right, because if wages go up too fast, that could push prices higher, leading to more inflation.
Exactly. It's a chain reaction.
And speaking of chains, remember those problems at Canadian ports?
Oh, right.
Palmberg says the disruption there could cost something like $800 million per day in lost trade.
Wow.
A lot of businesses are calling on the government to step in and help.
Makes sense. That's a huge hit. Especially since it's two of Canada's three biggest ports that are affected.
Yeah, and like we've seen with other supply chain issues these past few years, this kind of thing can really snowball.
Definitely. Delays, shortages, prices going up. It gets messy fast.
Okay, one last thought before we wrap up this giant deep dive. What stands out to you, given everything we've discussed, as the most important thing for our listeners to take away?
I think the big word here is uncertainty. We've got this U.S. election coming up. Nobody knows for sure how that'll shake out. Then there's China's economy. Still a bit of a mystery what their next move will be. And all these mixed signals we're getting from economic data all around the world. It's a time to be cautiously optimistic, for sure, but also to stay informed and be ready for some bumps in the road.
Well said. And that's where we come in, trying to make sense of it all for you. We'll be back tomorrow morning with the latest headlines from the financial magazines. Until then, happy investing.